Hello, everyone, and welcome to today's Servicing Advances webinar. I'd like to thank all of you for being here today. Before we get started, just a few housekeeping notes. All participants will be placed on mute during the presentation, but during our Q&A session at the end, please feel free to unmute yourself to ask questions. You can also submit questions through the chat or the question function inside your webinar app. This webinar will be recorded. The recording and the slide deck will be sent out to you within a few days. CPE credit is available to attendees who answer all 3 poll questions scattered throughout this presentation. If you are looking to get CPE, you must answer all 3 poll questions to be eligible. If you qualify, the CPE certificates will be sent out to you via email within the next few weeks. There will be a survey that appears on your screen at the end of the webinar. Your feedback is so important to us. We want to provide you with as much value as we can through these webinars. If you would take just a few minutes to fill that out, we would greatly appreciate it. For those of you who may not be familiar with Richey May, we were founded almost 40 years ago to focus exclusively on the needs of the mortgage banking industry. This singular focus from our experts enables us to help lenders accomplish their goals. Our experts believe in the forward progress and success of the industry and dedicate much of their time to teaching through webinars like this and building others through the MBA School of Mortgage Banking and at other industry conferences and associations as well. And now I'd like to turn it over to 3 of those Richey May experts, your presenters today. Seth, Rosie, and Mignon, take it away.
Well, good afternoon, everybody, or good morning, depending on where you are. It's just past noon here in lovely Colorado. My name's Seth Sprague. I'm a CMB. I'm a director here at Richey May of the Consulting Services. And we're really excited to bring this webinar to you today. Servicing Advances is an area that I get a lot of questions on constantly from our client base. And so we've decided to loop in a couple of our internal experts here to really talk about it. My role today is really just going to be a little bit of color commentary and talking a little bit about the impact on sales, but we're very fortunate to have 2 of our experts on advances, both from an operational and accounting side. So, and I say this in all nicety, you are probably going to want to listen to the recording of this conversation. There's going to be so much information that Mignon and the team here are going to provide that's going to be hard to write it down. But this is going to be a good overview and prep you for if you've done a servicing sale or you're in servicing, if you're using a subservicer, you've got advances, really helping to understand how to manage those advances appropriately from both an operational and accounting side, so that as we get through the year-end audits here in 2023, you've got your advances in a good position. So with that, Seth Sprague, CMB, happy to be here. I will be in and out on this presentation, but I'll now turn it over to Rosie, who will introduce herself.
Great, thanks, Seth. My name is Rosie Marlier. I'm a CPA and AMP here at Richey May. I've been with Richey May since January of 2015, and I am a senior audit manager in the mortgage banking practice. Mignon's going to kick us off, so I'll pass it to her.
All right, thank you. My name is Mignon Davis, and I've been here with Richey May for about 2.5 years. I'm the director over internal audit and subservicing oversight. We also do consulting and other advisory services. So those are kind of my areas of expertise there. And we'll go ahead and we'll talk about servicing advances today, which is one of my favorite topics. All right, so for today's agenda, we're going to talk about there's many different things with servicing advances, right? So you've got taxes and insurance advances, principal and interest, corporate advances. You know, we're going to talk about all of those different buckets. And like Seth said, we're going to talk about the impact with MSR sales and a little bit about CECL impacts as well. All right, so first we're going to talk about in-house servicing versus subservicing. You know, there's pros and cons to doing servicing in-house, and we're going to talk a little bit about that. So One advantage to having servicing in-house is that you have complete control over that borrower relationship, that customer, that member, taking care of them. You don't have to worry about a third-party service provider or a subservicer ruining that relationship or damaging your reputation in that sense, which sometimes people are in fear of, right? So you're in complete control of that relationship. Also, you have control of the data. And when we talk today about servicing advances, that's where this is really important too. Because a lot of times what we find is that our clients who have in-house servicing are really able to drill down to the details with their servicing advances. They know exactly what's going on and how to account for all of these things, even down to a loan level. And it's difficult when you use a subservicer. A lot of our clients are using the subservicer's invoice detail on the servicing advances, and a lot of times it doesn't break it down into enough detail on the loan level to really identify what those servicing advances are made up of. So that can be a challenge and definitely an advantage to in-house servicing. So some of the cons though of in-house servicing is obviously economies of scale. As you grow your portfolio or sell off pieces of your portfolio, it's going to impact staffing one way or the other. You've got to size up, size down, and that can be difficult. Also, it's very cash intensive. There's high fixed costs associated with servicing in-house. Just all the staff that is required for all of the different servicing functions. And also there's compliance, right? Our favorite thing, ongoing compliance and all of the moving parts that go along with compliance. It's always changing. Federal regulations are changing, state regulations are changing, agencies and investors are changing their guidelines, always things to be keeping an eye on and changing. So the other thing is technology costs. You're gonna have to have a servicing platform, which is a big investment. So definitely significant expenses there with in-house servicing. Now going over to subservicing, if you decide to use a subservicer, a lot of the pros and cons are just kind of the reverse of what we just talked about. Lower operational responsibility, right? You don't have to staff up an entire staff full of all the different servicing functional areas, right? You just have a handful of people overseeing that relationship, maybe doing some QC work on the subservicers work just to make sure that they're above par. You've got knowledgeable resources with your subservicer, and that's an advantage. Also, you have shared services such as technology. You don't have to invest in that servicing platform. Your subservicer has it. They're going to give you access to it. Cons can be, that the costs are unit based. So again, as you grow your portfolio and add to it, you've got a per loan cost associated with that subservicer. Now, if you service in-house, you do have some changes there with if you grow your portfolio, you may have to add staff, but there is a certain level of growth that you can handle typically before you need to add to staff. So that can definitely be an advantage to using a subservicer there. So another con to using subservicing or a subservicer would be that you're going to have to share in the ancillary income. So late fees, for example, if you're servicing in-house, you get to keep all of that revenue from late fees. If you're using a subservicer, depending on your contract, you may have to split that ancillary income and also float on escrow. A lot of times you can either split that with the subservicer, or sometimes the subservicer just takes advantage of that 100%. So just depending on how you work that out with them. So so those are some pros and cons to each. So it just depends on what you're looking for. All right, let's go ahead and move on to the next slide, which is poll question number 1. How does your company handle servicing administration? A, you service in-house. B, you utilize a subservicer. C, a combination. Maybe your Ginnie Mae loans are with a subservicer and you service in-house everything that's, Fannie and Freddie. Or D, you do not currently retain servicing.
We'll keep the poll open just for a few more moments. Make sure everybody who would like CPE has a chance to vote. Just gonna wait. I think there's a few folks out there that probably still need to come in. Don't want to miss this if you can. Okay, I think we have everyone. We have close to 90% responding, so I'm going to go ahead and close that. And then I want to share the results, and hopefully that you can see this, Mignon. 25% said in-house, 52% said subservicer, 5% said combination, and 19% said we do not currently retain servicing.
Okay, and I think that's typical to what we see is that, you know, above half use a subservicer. You know, they've just decided that that's a risk that they are willing to, you know, share and have that counterparty risk relationship there instead of taking on the risk all themselves. So, okay, thank you. All right, so now we're going to talk about the different types of advances. So the best practice that we have seen is to not only track types of advances on the loan level, but also to kind of categorize them into different buckets. So, you know, there's lots of different buckets that you can use to really drill down the information and get a good idea of what your servicing advances are comprised of. So you've got like agency and investor buckets or categories that you can use, PMI, if there's PMI on some of your portfolio. You can drill it down to principal and interest bucket, taxes and insurance, corporate advances. So there's a lot of different ways that you can really categorize this and get a good perspective of what's happening within your portfolio. So the first thing we're going to talk about is taxes and insurance, otherwise known as escrow advances. So, you know, when loans are performing and the borrower's making their payments every month, a portion of that payment, if the loan is escrowed, is going to go into a separate escrow account. The money sits there, and when taxes and insurance are due, that money is ready to go and it pays the taxes and insurance and everything's good, right? When loans become delinquent, then we have a problem. That escrow account quickly depletes and there's no money in there when it comes time to pay the taxes and insurance, right? So that's when you're going to have that expense, and that's going to be an advance that the servicer or the mortgagee is going to have to make. So definitely something to be on your radar as your delinquencies, you know, in your portfolio change. That's going to change your escrow advances either up or down according to, you know, the delinquency percentage. And mortgagees do have to do this because it is something that they're required to protect the interest in the property for the investor. So it's not something that you can, you know, not do. You have to do it. Now, one thing to keep in mind though too is that once a loss mitigation option is completed or a foreclosure is completed, when you go to submit that claim to the investor, a lot of times you can recover this money for taxes and insurance. It's just going to be, you know, a period of time before you get it back. So depending on what happens with the loan, you could be, you know, those advances could be on the books for, you know, a couple of years if it's in foreclosure. One other thing to consider too is for loss mit partial claims, you can a lot of times not only include escrow items that you've already advanced, but projected escrow shortage amounts as well. So something to think about too. Definitely a lot of moving parts with claims and a lot of different things that you can do depending on what's happening with the loan. Now the timeframes also vary from one agency or an investor to another. An example would be like Freddie Mac. If you are doing a loss mit option on a loan, you have 90 days to submit that claim after you've completed that loss mitigation milestone. For Fannie Mae, same scenario. and it's 60 days instead of 90. So definitely different timeframes on submitting that claim, and that has to be monitored. Those timeframes need to be monitored, because if a claim is submitted late, it may be denied completely or just curtailed, and you can't recover everything, and you just get a portion of it back. So it could be reduced. So definitely important to keep an eye on those timeframes. And this is why we really want to drive a point home, is that accounting professionals within the organization need to really work closely with the servicing staff, have that open line of communication, and be talking about servicing advances and understand that process and reach out to them anytime you need to, because there are so many moving parts here. All right, so we can go on to the next slide, which is for principal and interest advances. And a lot of different scenarios here for principal and interest too. So if you have Ginnie Mae pooled loans, for example, the issuer is obligated to make full payments of principal and interest to the investors while that security remains in the pool. Now you can buy out those loans from the pool, but you can't do that until the third missed payment. The first two payments are considered just delinquent. That third missed payment, that's when it's considered in default, which is when you can pull it out of the pool. Also of note is that when you file the claim later, the way they calculate the interest, the computation of that debenture interest is calculated off of that default month, so that third month. So when you claim that money back to the investor at FHA, it's, you're going to be using that default date, the third month, as the date the interest goes back to, is potentially losing those other 2 months. All right, and we're going to talk about, next slide, remittance types. There are 3 different remittance types that we need to be aware of here. And I think it's especially important for those clients who use subservicers. When you're looking at your subservicer invoice and you're looking at your advances, you want to make sure that you don't have any principal and interest advances on any actual to actual remittance type loans. And I'll explain that. So for an actual remittance type, that is where you are required to pay the investor principal and interest based on the actual collections from the borrower. So every time that borrower makes a payment, a full payment, you are remitting the principal and interest back to the investor. If the borrower does not make a payment and they go delinquent, you do not remit the principal and interest to the investor because you didn't receive a payment. It's actual. Actually, what you receive is what you send to the investor. The second type is scheduled. And this one is where you are required to pay the investor the principal and interest based on the amortization schedule. So, the borrower is scheduled and due to make a payment this month, but they don't make it, you still have to pay that principal and interest to the investor because you're following that scheduled amortization. The third remittance type is kind of a combination of the two. It's called scheduled actual, and this one, you pay the investor interest, not principal, if the borrower does not make their payment. So if the borrower does make their full payment, you're paying principal and interest just like normal. But if they're delinquent and you do not receive a payment, you only have to pay interest to the investor, not the principal portion. So that's kind of where it's, a little bit of a mix of the two. So based on this actual remittance type, if you use a subservicer and you see on your invoice that some of your loans in your portfolio that are actual remittance types, if those loans have principal and interest advances, that would be a red flag for you, something to drill down and talk to your subservicer about, because that shouldn't be the case. All right, now I know this is a lot of detail, and we are really going through a lot of different things. So hopefully you guys, your heads aren't spinning too much. We're gonna go on to the next poll question, and just hang in there with me. We've got a few more slides to go through.
And Mignon, I'll read this since I had to shorten it slightly.
Okay.
If a loan is delinquent and the lender has not received payment from the borrower, what needs to be remitted to the investor for a scheduled loan? And again, we want everyone to answer this who's looking to get CPE. So we'll just hold it open for a moment. Almost there. Want to get us close to the 90% that we were at last time. And again, we just have to answer it. Don't have to worry about getting it right. Okay, just waiting for a few more folks if they can come in. If you haven't answered, I need you to answer now so I can close it. Only about 83% are in right now, Mignon, so I'd like to hold off just another moment, see if I can get more in there. But I think we're done. Can we go ahead and close this? And there are our answers. How'd they do?
All right. Yes, it looks like they're right. 82% principal and interest. So on a schedule-to-schedule loan, if the loan is delinquent, you still have to pay principal and interest. So A is correct.
Fantastic. They did a good job. Let me return you now to the slides. There you go.
All right. Okay, now moving on to corporate advances. There are a myriad of different types of corporate advances. I just listed a few here. You know, legal fees for foreclosure or bankruptcy, you know, those are pretty common with defaulted loans. Non-routine litigation if the borrower is contesting the foreclosure. A lot of times you have title work, clearing title, or making sure that title is you know, going to be clear to convey back to HUD or whoever the investor is. Property preservation, HOA and condo assessments, especially in super lien states where those HOA and condo liens take priority over the mortgage. Definitely have to pay those. Utility bills can be a corporate advance, especially for HUD loans when you're getting ready to convey the property back to HUD. You got to be current on and paid up on all the utility bills. And other eviction fees and costs, but there's just a lot of different things that fall into this corporate advances bucket. So, and these typically are claimable on the investor claim. And we can move on to the next slide. We've got a little bit more information on the claim process. So talking about corporate advances still, you can claim those on the investor claim. However, it's important to note that the agencies and investors have a schedule of allowable expenses. So you need to be using that allowable fees schedule. And anything in excess over and above what they've said is allowable in that state for that process, like filing a proof of claim in the state of Arkansas, you know, it's really dialed down to the state and to the actual legal process that you're paying for. And anything over and above that, you need to ask for approval. Otherwise, you won't be able to claim that back on the claim to the investor. Also, you need to make sure that you're paying attention to your servicing milestones and reasonable diligence timeframes. If those milestones aren't met within the timeline required and it's a curtailable event, then HUD will curtail the interest on that loan. And when you file the claim, you're not going to be fully reimbursed for everything. Mortgagees also have to request extensions with HUD when needed. So if you feel like you're not going to hit that milestone in time and there's a reason for it, you need to submit an extension request with HUD, and that needs to be approved by HUD. You need to follow up and make sure it gets approved, save the approval, and that needs to be submitted with the claim. Otherwise, your claim is going to be reduced or just not paid, denied entirely. Also, there are requirements with the SFDMS reporting, and if those requirements aren't met, your claim can be reduced as a result of that as well. Another thing to note is that HUD has a tier ranking system. So for tier 1 mortgagees, HUD pays a higher percentage back to you on the claims for legal fees. And if you're a lower tier client, you're going to receive a smaller percentage back on your claim. So it's important to know what your tier ranking is. And if you don't know, you can find out through HUD, and you can, you know, they share the metrics with you that they're looking at. So you can try to improve those metrics and try to raise yourself into that top tier, and you can recover more of your money back on your claims by being a higher tier. All right. Okay, let's move on to the next slide. So yeah, corporate advances for recoverable and non-recoverable. Sometimes, depending on the context, we've been kind of talking about claims. In this context, I'm going to be talking about recoverable and non-recoverable, and talking about the borrower. So recoverable from the borrower. So there are some items that you can charge to the borrower. So if they reinstate, pay off the loan, or even roll into a loan modification, you can add some fees into that loan modification or collect it upon reinstatement or payoff. It depends on the state. It depends on what the fee is. There are laws in some states that prohibit you from charging certain fees, so you need to really understand that. And if there are laws prohibiting you from charging certain fees to the borrower, you can include those items in your claim at the end, your investor claim. One thing to note, though, is that Fannie Mae is very specific about they will not reimburse you for items that should have been charged to the borrower, that were recoverable from the borrower, but you failed to collect it or failed to charge the borrower that. Say they reinstated and you didn't include all the fees that you were supposed to, and now you try to make a claim to Fannie Mae, they're going to deny that. They're going to say you should have included that in the reinstatement quote to the borrower. They should have paid it. So if you fail to collect it or just make a business decision not to collect it, they're not going to reimburse you for it. So something to keep in mind. So anyways, other examples of non-recoverable items that you don't always charge to the borrower could be express mail or courier services. I mean, there's a whole bunch of different fees, and you really need to have a matrix or something that will guide you in that process, because every state is different with regard to different fees. So as you can see, there are so many different moving parts with claims and servicing advances. So it's really important to, I really want to stress that accounting staff should be working closely with servicing to understand these processes and make sure that, that on the accounting side, they are prepared for these types of advances and they know what's coming. So now I'm going to turn it over to Rosie, and she is going to talk more about accounting and auditing considerations with regards to servicing advances.
All right, thank you. Yeah, so some accounting and auditing considerations that you want to keep in mind. During audits for really any receivable, including advances, our main considerations are going to be how significantly aged are the items and whether or not they're collectible. So typically we see with our in-house servicers, they have really robust accounting systems for these servicing advances. They'll have different really granular general ledger accounts that keep track of everything really efficiently. However, the companies that are utilizing subservicers tend to vary in their understanding of the operational processes. So what we'll see at year end is a lot of times they will rely solely on the subservicing invoice that they get each month. They'll see that there's some sort of due to or due from the subservicer based on the cash that was collected or what was paid out on their behalf. But they can't really validate the underlying detail of those actual advances. So this tends to result in really messy schedules. Clients might not know actually how to reconcile back to their trial balance. That ends up happening is you could have to go back years and unravel all that activity, which is not only very time consuming, but can be really costly to our clients. So it was sort of touched upon by Mignon, but the best practice is to track not only on a loan level basis, but also segregate them into buckets based on certain identifying factors, such as the agencies, different insurance types, if that's applicable, whether you have recoverable or non-recoverable advances, and then obviously those P&I, T&I, and corporate advances buckets. And then another accounting issue that we tend to see is that our clients will fail to set up some sort of allowance on uncollectible servicing advances, or they could actually have one set up, but then when they're actually incurring some sort of losses down the line, they're running it through a different part of their P&L. or they could be running it through their loan loss reserve. The allowance for uncollectible servicing advances in the loan loss reserve should be 2 separate accounts most of the time. However, when you're establishing them, you can still use various considerations, such as what are your historical collection patterns, what's the timing and recoverability of my servicing advances. You just want to make sure that it's reasonable and can help you avoid some major losses down the road. And then finally, escrow administration and loss mitigation are really large sections of the compliance piece of HUD audits. So failure to support the FHA claims, failure to prove that you're remitting your escrows timely, or if you're unable to show how you funded advances and the specific cash accounts that everything kind of came and transferred from, that can result in MLPs and findings, and you don't really want those being reported during your lead process. So it's really important that your accounting team has these really buttoned up before you go into your year-end audit. Next, I'm going to pass it off to Seth, who's going to kind of cover the MSR and loan sales and how servicing advances permeate into those.
Great, thanks, Rosie. And a couple of things just to emphasize that we've talked about, because remember, servicing advances are very complex, and there's an operational aspect, and then there's the accounting side. But I'm just going to give you a couple of things before we talk about MSR sales, just to sort of give you a couple of words of wisdom on somebody that's had may have worked some places where it may have some issues with their advances. A couple of things to remember. One, on those schedule remittances that Mignon talked about, you may be thinking, geez, I've got a bunch of Ginnie Mae loans that are delinquent and I don't see the cash flowing out. Remember that as long as there's adequate funds in those schedule remittance accounts, the MBS on the Fannie Freddie side and the Ginnie Mae fund, as long as there's adequate paid in fulls, at the loan level, you've made advances, as Mignon talked about, but you may not be out of cash. And every time we talk about advances sort of holistically, people are like, well, I have delinquencies and I'm not making any advances. Well, there may be adequate funds from paid in fulls masking your true cash advances. So it's something to be aware of. It's something to be monitoring, that the paid in fulls are likely masking some of those potential advances on those schedule remittances, particularly with Ginnie Mae's. And as prepayment speeds tend to slow due to seasonality, you may end up in a situation sort of in a January and February under Ginnie Mae's where you actually have servicing advances that you actually have to come cash out of pocket for because prepayment speeds are so slow typically during that time period. So wanted to talk a little bit about that. Mignon mentioned the debenture rate, right? The debenture rate is something that you earn from, in essence, that's the interest that they're paying you for those advances. And the interesting thing about the debenture rate is it's set, as Mignon talked about, at that definition of delinquency, or 90 days. And it's actually sort of the 10-year treasury rate. But as you think about what's in your servicing portfolio today, particularly on FHA loans, think about the difference between a 3% FHA loan going delinquent and a 7% loan going delinquent, and what you're earning is the debenture rate. You can actually be debenture rate positive on some of that really low coupon stuff that's going delinquent because you're advancing at 2 3/4 or 3%, but you're then you're going to be paid the debenture rate in the 10-year treasury as of the delinquency date. So again, it varies, and so you want to just make sure you understand that debenture rate concept and how it's set and how it's going to be adjusted. And just one thing that I know Mignon chirps about this all the time to me, but fair servicing, that grid she approached, that grid she talked about on fees that you may waive or not waive, make sure you're applying that consistently, because that's something that regulators will come in and then go, well, this person you did this for and this person you didn't. And make sure that is well documented, that that's the policy and you're applying that policy very consistently, sort of across all of your servicing customers, because the last thing you want to do is fine for sort of having inconsistent methodologies as to what you're waiving or charging back to customers. So that's when you mentioned that grid that you want to make sure that you've doing that appropriately. So we go to the next slide here, but the impact of MSR sales, and I'm always surprised anytime somebody's doing an MSR sale and they get into this level of detail now in advances. So at the loan level, remember these advances are being made. So you actually may not have done the cash. If you can advance the next slide, Rosie. And so on bulk MSR sales, remember that Fannie and Freddie, you could do loan level selection. So delinquent loans or loans with advances might be excluded. But when you sell Ginnie Mae servicing, you have to sell the entire pool. And more than likely, because of the nature of Ginnie Mae servicing, you're likely to have some level of advances in there. So remember that those advances are dollars that you have, either paid for directly with cash, or they've been funded through that paid in full float that exists on those schedule remittances, and that you should get that money back from the acquiring entity. So when the buyer of servicing in these transactions actually needs to reimburse you for those advances, because ultimately, if they're deemed recoverable by the buyer, they will get that money back. If they're deemed not recoverable, you will not get paid those monies. So embedded in your servicing contracts, embedded in any MSR transaction is going to be language around the timing of the recovery, and there's going to be language about if it's deemed recoverable, then you'll get it back in this time frame. The typical terms around reimbursement tend to be about 60 to 90 days after the transfer, not after the sale date, after the transfer. Because remember, that new servicer needs to go through and evaluate the advances. And as Rosie pointed out, if your advances are messy and you don't know if they're really corporate or T&I or P&I, it's going to present some challenges for you as you do a servicing trade. So it's one of those lessons, unfortunately, that we see people do all the time, is that they get into an MSR trade and then their advances aren't quite as clean as they think, and they struggle to get those advances paid back appropriately. And remember, that would be 60 to 90-ish days after the transfer, because you need to give them a little bit of time to assess the collectability of those. When it comes, and Rosie, go to the next slide, if it comes to whole loan sales, the impact of advances, remember, whole loan sales are different. If you're a bank and you're selling some of those special portfolio loans that you created that are in your portfolio, you likely have a lot of advances. And if you're a bank and you're selling sort of that portfolio product, make sure you coordinated with the accounting department to relieve the advances appropriately when you get that money back. As Rosie pointed out, there's a lot of times those advances get very messy. As I like to say, the hygiene of cleaning up those advances isn't as strong as it should be. And then you end up with this receivable that the loans don't exist anymore. And then you kind of have to explain to your audit team what happened. So whole loans, if you're a bank and you're selling sort of some of that special delinquent product or loans that you have repurchased or NPLs, there's a lot of advances, and make sure you've got them cleaned and documented well. I know when Mignon does a lot of our subservicer oversight or deep dives on advances, that's a big area of concern and risk out there, that you don't have them not properly accounted for, transactions and the documentation to support those advances. Then they won't be deemed recoverable and you won't get them back. So ensure they're properly tracked within the financials, and coordination and alerting the wire team that you expect advances back 90 days after that sale MSR transfer date, so that they can clean up the appropriate accounts, let accounting know what's appropriate, and you should have a level of expectation of what those advances are. So when that wire comes in, you know exactly how to account for it within the GL system. It sounds like an easy process. I can tell you multiple times I've had this not go as smoothly as I wanted in past lives. So if you're doing MSR sales, make sure you've read the contract, make sure you know the terms, make sure you know when you're going to get that those dollars back in. And Rosie, we go to the next slide, and then we're going to handle some Q&A here. I guess this is back to your slide, and I'm going to wrap it up.
Yeah, so Seth, you really hit the nail on the head. A lot of clients that I've spoken to are seeing more EPDs. They're anticipating potentially more foreclosures down the line, and therefore are anticipating some servicing advances that are going to be increasing. So when you're going into these sales, you want a clean balance sheet. You want to track exactly what is owed to you. You don't want to be leaving money on the table, especially in this market where companies are concerned about liquidity and just staying afloat in general. As we've discussed, there's a lot of times a disconnect between the team performing loss mitigation and servicing operations and the accounting team. The accounting team needs to make sure that they also have a solid understanding of all the important milestones Mignon discussed throughout the claims process. You want to work with your servicing ops team, making sure that deadlines aren't missed and that cash, that you're losing out on certain cash that could be collected after the sale. Ultimately, at the end of the day, if a CFO has, $10 million of servicing advances on their balance sheet and then finds out that they can only actually recoup $5 million of that, you are going to run into a situation that it's ultimately still going to come back on the CFO, even if they're not involved in the day-to-day operations of this. All right. We are going to move on. Oh, sorry, go ahead.
Oh, I'd say poll question 3.
Yeah, okay, sorry. So yeah, poll question 3. Felicia opened it. How sophisticated is your company's process of tracking servicing advances? A, very, B, somewhat, C, not at all, or D, after day, we're not sure anymore.
Call Mignon if you're answering D to this.
Yeah.
And call Rosie to make sure you got the accounting squared away. Don't call me in advances. I'm not going to help on either one of those sides. I can only tell you the pitfalls to avoid. I think I've stepped in every one of them.
The answers are definitely coming in faster this time. That could be part of it. Let's just give it just a few more moments to get that percentage up so everyone can get the CPE that they would like. We've got about 80% of the group in there. Let's see if that stays where it's at. If you would like CPE, please take a few moments to vote here. Okay, looks like we might be right where we're going to be. So let me share the results of what we found out. So it's a good thing that we are having the experts on the line here for some Q&A after we speak about CECL, because we might not be so sure anymore with 21%, but somewhat at 46 looks good.
Good. All right, yeah, and then just a quick blurb. I know people are interested in the CECL impacts. CECL is effective for periods beginning on or after December 15th, unless there was some sort of extension, which might go to January 1st. That means that your audit this year is impacted by CECL. So I know over the past few years leading up to the actual implementation of CECL, there's been kind of conflicting information out there surrounding servicing advances. In our opinion, because these are truly advances and not actual loans, there's not really a credit loss component of this. Even though the loans that actually have servicing advances attached to them might be sitting in loans held for investment, that's more of the asset class that will have an impact on CECL. So no huge impact as on the actual servicing advances when it comes to CECL. So I'm going to kick it to Seth. Planning for 2023, what do we think?
Yeah, so planning for 2023, I think the most important thing too is understand calendar implications. Or one of the most important things is calendar implications. So if you haven't done your holiday travel yet, December 29th is a Friday, December 30th is a Saturday, December 31st is a Sunday. I'm going to make a bold prediction here that your delinquencies in December are going to spike. Why? Because you've got 2 less processing days. And so one of the things that I know some of the subservicers are very good about alerting their customers of is that when a month end or a quarter end is on a weekend, you lose loan processing days. And there's a number of borrowers that actually do make their payment right at month end. And so I would expect that delinquencies would definitely tick up in December outside of normal seasonality, just because due to the fact that the last 2 days are a weekend. And you might see a little bit actually in September as well, because September 30th is a Saturday. So you probably will see a modest uptick in delinquencies in your servicing portfolio and therefore potential advances in September. Certainly see one in December. So plan ahead based on the calendar, sometimes with delinquencies. You should also plan on that for servicing fees, right? Because you only collect that servicing fee when the borrower makes that payment. So what I would expect is that December will look like a light servicing fee month compared to January, when those payments sort of get processed across on the first and second after the holiday. So the calendar actually matters a lot sometimes when it comes to the delinquencies as well and advances. With that, we got some questions coming in, so I'm going to attempt to read them. The questions are over here, the camera's over here, so I look over here, I'm trying to read questions. But I guess this is the first one is probably for Rosie. So Rosie, you're the lucky one here on advances, but you had mentioned the fact that you might want to, best practices are to calculate a reserve potentially on advances. So can you share a little bit or just expand a little bit more on sort of how do you go about calculating what that reserve is?
Oh, sure. I've really seen it kind of run the gamut. It's going to depend on client to client and a lot of like their sort of portfolio makeup. I've seen companies taking into consideration everything from whether they're in a judicial versus a non-judicial state. The timing that you collect those advances back could take years versus, some are 2 years, some are 10 years. You want to make sure that you're kind of factoring that in potentially. Do you have a large Ginnie Mae or FHA portfolio? It's going to be dependent on how advanced the client is with the claims process. Are they tracking it all the way through? Do they know exactly how much they usually get back from that? Do they have every single invoice for every single winterization and all of that kind of stuff? It's very operationally burdensome. So I think understanding your servicing team and how successful they are in actually getting all those collections back is really important. All of those types of things are going to factor into what you actually think you're going to be able to collect at the end of the day. So not really a one size fits all, but you should be considering all those types of factors when you set up an allowance.
And I would say that if you've gone through this training, you need less a reserve now because you understand what it is more, but I can't give you accounting advice. Mignon, kind of the same question for you on that. When you're dealing with kind of the subservicing oversight or doing sort of the deep dive on some of those advances, kind of what's the level of documentation that you're seeing, and are folks sort of surprised when you say, well, where are your invoices for, as Rosie said, winterization, and they kind of look at you go, I don't really know what you're talking about. How is that prevalent kind of across what you see when you're dealing with sort of that subservicing oversight function?
Yeah, typically we do see that invoices are okay. Like usually they have the invoices. Where it becomes problematic sometimes is like the missing of the milestones and the other curtailable events, due diligence timeframes being missed, and then also, if you need an extension on a particular milestone, say your first legal due date, you don't feel like you're going to meet that date and you need to request an extension from HUD, you really have to follow up and make sure that that extension is approved, and you have to save that approval and submit it with the claim. So, again, that is, to Rosie's point, very operationally burdensome. Also, excess fees and costs, you've got to, if it's over the allowables on the allowable schedule, you've got to submit a request. Say if the foreclosure is in litigation, is being contested, you need to ask for additional fees and costs to be approved. You need to save that approval and submit it with your claim later. If you don't ask for that approval, they're not going to pay it. The investor is not going to pay it. So, just keeping track of all of those things. And again, it's just a matter of your operational team and their record keeping and how diligent they are. I feel like invoices from vendors are usually pretty easy to come by, because even if they are perhaps lost on the servicer's end, you can always go back to the vendor. Hopefully they have a record of everything. I feel like it's the extensions and other approvals internally that kind of become a hiccup.
No, that's a great answer. So, I mean, it's really dependent on how they work with your auditor to make sure that the reserve is appropriate based on your sort of facts and circumstances. We've got another question, and I'm going to kind of paraphrase it a little bit. So I'm going to, if we don't kind of hit this one on the head, definitely kind of hit us back. But the question more is along that there's some current loans and they have advances on them. And I'll handle part of this because it asks particularly around MSR sales and whether or not advances would be covered or would be paid for. But one of the things I always look on a servicing tape is you can certainly have advances on current loans, and those could be escrow advances, right? You've just gone through an escrow analysis. The escrow account was short, and you've had to make advances. So you could certainly have advances on current loans. If you sell loans to a correspondent, sometimes they're going to really take a deep dive on that correspondent. Are the escrows appropriate on the closed loan? Maybe they're on undeveloped land, because you only charge escrows to a certain account. Mignon, can you kind of comment on what you've seen in that space, certainly on current loans with any advances that are allowable? Or
Yeah, and I think on this question too, they were specifically talking about corporate advances, and I have seen clients really allow the borrower to reinstate without paying all of the corporate advances. That didn't used to be a practice, but now I think, a lot of servicers are trying to keep people in their homes. They're trying to do right by the borrower. So, if the borrower is able to get current on their payments, but maybe get a payment plan or something like that to eventually pay back the corporate advances, or perhaps, capture those when the loan pays off later. I think that is going to be more of a trend that we'll see going forward, where before we used to just say, nope, we're not going to accept reinstatement unless it's a full reinstatement of corporate advances and everything. And otherwise we'll just proceed with foreclosure. Now it's just, I think we're working with the borrowers a lot more, and we're going to allow that type of thing. So that's more of a business decision there. But again, to your point that you were talking about fair servicing earlier, I think if that is something that you want to do, you want to make sure that that's a decision across the board, and that you're not only doing that for just certain borrowers, that it is something that you would allow across the board. Now, as far as an MSR sale, what would happen to those corporate advances that are hanging out there on current loans? I'm not sure about that piece of the question. I don't know if you have any experience with that.
Yeah, it would really be post that transfer of that servicing, and they get deemed either recoverable or non-recoverable. And I have seen in past lives where people are arguing whether or not it's recoverable or non-recoverable. Look, on a current loan, corporate advances are kind of hard to say why they're recoverable. They could have been something legacy that we had talked about, right, where the borrower may have been delinquent at some point, and that you didn't clear that invoice, or you didn't clear that as you kind of reinstated the loan. And so those may or may not be recoverable at that point. We've got time probably for one more question, and the question is on Black Knight's MSP system breaks down between recoverable and non-recoverable write-offs. We don't normally have an allowance for uncollectible servicing advances. Is there still a good rule of thumb for a certain portfolio size that you could create an allowance for? So maybe, Rosie, this might be more of like a materiality question around recoverability or adjusting those advances. I don't know if what you guys see for large versus small.
Yeah, I can't. obviously the larger ones are going to be the ones more likely to have to establish some sort of allowance. I don't have an exact number for the portfolio size for what the good on that. But with those advances or the advances, when you're considering the losses that you might be incurring, you want to have a track of them, because if they all come in all at once, all of that's going to be just a hit to your bottom line all at the same time, versus you could actually be doing calculations based on all of your historical business and your portfolio makeup and all of that, and actually sort of buffer that in, making sure that each month you're, from an auditor, I'm not saying, smooth income or anything like that, but if you have a good track of it, your balance sheet is more realistic, and you can just adjust within the actual reserve, in the actual allowance, so that you're not taking these absolutely massive hits down the line once you actually realize, oh shoot, this loan isn't even around anymore. If your auditor comes in and says, hey, you haven't advanced for this loan, you don't even have this loan anymore, then all of a sudden you're taking these huge write-offs, and if you haven't factored that in, it could be a big hit. So I would say, just knowing from your company and your operations and how clean your balance sheet is, I think it'll really actually help you guys sort of manage that down the line.
Great. And Mignon, I think the last question's to you, and then we'll wrap this up. But I guess it kind of, I'm going to paraphrase again, from subservicing oversight function, do you get access to LoanSphere to review foreclosure and bankruptcy invoices? The person writes, I find these an MSP file, and reviewing them, such advances becomes very burdensome. So any color around that as you're kind of reviewing invoices?
Yeah, typically we don't get access to LoanSphere, but they will save those invoices into their document retention system, so we will have access to those invoices that way. Yeah, so hopefully that answers that question. I mean, yeah, we do usually get access.
Okay, and we got one more, and I guess this is back to you, Mignon. Do you have a team that specializes in ensuring that advances are feeding correctly into the GL from the servicing system? Or maybe it's a question for our internal audit folks. We might need to take that one offline, Felicia, and get our internal audit experts to ask that, unless Rosie knows the answer. I don't know the answer about ensuring those advances are fed correctly into the GL. I think we may have to come back to that person.
Yeah.
We sure can. And with that, we're almost at the, I'm sorry, go ahead, Seth.
I was gonna say, we're out of time, so I'm going to turn it over to you to wrap us up.
So thank you all again. I'd like to apologize for a little bit of those sound issues you are hearing during Q&A. I assure you we are not having any tornadoes or any issues in Colorado, but thank you all for staying online, and we will get back to the questions that we didn't have a chance to answer. Thank you so much for them. But if you go to the next slide, Rosie, I just want to point out, as you listen to the recording, when you get it, please reach out to this email address if you have any more questions for our experts, and we will also get back to you right away. And with that, I would just like to remind you, you'll get the slide deck and the recording, as well as your CPE certificate shortly. And thank you so much for attending today. We look forward to seeing you on our next mortgage banking executive education webinar. Thanks again, everyone, and have a great day.
Thank you, everyone.
Thank you.